Hello, everybody, and welcome to our next edition of Strategic Wealth Live, our weekly webinar series. Today, of course, we're going to be discussing the three different investment worlds, what that means, how to utilize each one of them, what's good and maybe what's bad about each of them. And then at the very end of today's webinar, which I'm going to try and keep down to probably somewhere in the neighborhood of 30 to 40 minutes, I've got a very special offer that we will be making to everybody. So you want to make sure that you stick around to the end. If you've watched this before, you know, we usually like to allow everybody some time to log in. So I'm going to run a short video for you that shows some of our most recent news clips from some of our news appearances. And then when that's over in about a minute or so, we will jump into things and get started today. So enjoy.
Viewers out there were set to retire in the next 18 months or so and have seen accounts drop by as much as 30%. That's huge. What do you say to this group and what they should do?
Yeah, the main thing is to try and take advantage of the opportunity that we have right now, because the market has rallied a little bit, to put a safety net underneath your portfolio. So if things get volatile again moving forward, you don't have to watch your assets go back down in value again like they have basically over the last 20 to 30 days. So individuals really need to take advantage of the opportunity we have right now to lock in their assets, because things could get worse as we start to see the unemployment numbers continue to go higher. Corporate earnings are going to be released next month, and all indications are it's not going to be good.
This stimulus bill, it was given credit for raising the market quite a bit last week. I don't know if that's the whole reason, but a lot of people gave it the credit. Is that going to last? Was it enough? And, you know, that all important question, you know, is the worst over with the market? Can we say that?
Yeah, I think a lot of people was optimistic because this is a great headline. It is great that we're getting a $2 trillion stimulus. But if we think about the GDP for this country's over $24 trillion a year. So this is really only 1 month of that if we shut down all businesses, which is basically what's happened.
You're the guy that knows the most. So rapid fire, my friend. Number one, is there anything I can do right now or I ought to be doing with my retirement or my investments?
Number one, the big thing right off the bat is have a plan. We're in crazy uncharted times economically, and it's really easy to react to what happens in the market on a day-to-day basis. So the first thing would be have a concrete plan that you can stick with, because if you don't have a plan, it's like you're flying through retirement without air traffic control. And if you're flying without air traffic control, you may not get to your final destination.
Okay, hopefully everybody enjoyed some of those clips. For those that have joined us here today, again, we're going to be speaking about the three different investment worlds and when to utilize each of the different investment options that some of these different competing entities offer us from time to time. And really what I'm going to be doing is explaining to individuals why you hear what I refer to as conflicted advice. You know, sometimes you'll talk to one financial advisor and they'll say that you should always avoid these types of investments, and another advisor will say, no, those are the best investments that are out there. We're going to talk about some of those differences and why you're hearing some of those things. But first, before we jump into the presentation, of course, giving a little bit of an economic update each week as we air these different webinars. Since we last talked, of course, we've continued to see unemployment numbers increase a bit. That is expected to continue. We have also had additional businesses that have said that they unfortunately are probably going to have to close their doors. I think most recent surveys showed that about 25% of small businesses had already had to close their doors, with another 40% saying that they may need to within the next few weeks to months, depending on how long this economic shutdown occurs. And then most recently, we had some data come out from the IMF, the International Monetary Fund, who basically looks at, you know, GDP numbers globally, not just here in the U.S. And interesting, in a report they came out with here within the last few days, they said that economic output for each employee or each worker within the system is going to contract at over 4% this year if the shutdowns were to end soon. And that may not mean a whole lot to you, but the interesting statistic that I was paying attention to is the fact that during the financial crisis of 2008 and 2009, output shrank by about 2%. So it's more than double the impact of the financial crisis. And we're seeing that where some industries are saying that this is much worse than the basically September 11th and the financial crisis combined. They expect the global economic growth this year to go negative 3 to 4%, which is down from what they expected to be a 3 to 4% increase. So it's basically an 8% swing in 1 month. And they said unless we can get the infection rates down and the shutdown reduced, then another 8 to 10% drop shouldn't really be that shocking if that were to occur. And so not so great economic news, which is one of the reasons why we're continuing to do these webinars to bring individuals education and information about what we're seeing. And quite frankly, what do you do about it? Because I think one of the biggest mistakes we could make right now would be to just, sit tight and do nothing. Of course, like we always say, you don't want to panic, but you need to be taking a look at your investments, maybe getting a second opinion if you're not hearing anything from your current advisors or if you've been doing things on your own, and making some adjustments. Because one of the last points that the IMF pointed out was the fact that what we're seeing right now, that really the only time period that you can compare that we've seen in the past is going to be the Great Depression, which of course began in 1929. And again, if you've been following us here over the last few weeks or months, you know that during the Great Depression, the stock market fell a total of about 86% from the very top to the bottom. And then it took individuals 16 years to fully recover from that and break even, get back to where they were before the stock market correction occurred. And so the idea that we're just going to ride this out and wait and kind of hope that things bounce back as the governments allow us to start opening up the economy again, I think that that's really, really dangerous if you are close or in retirement already. If you're already retired, you can't do that. And I think if you're within 5 years of retirement, just waiting it out and seeing how things go, that's just too risky as well. So let's jump into the presentation here today, and I can probably give you some information or guidance as to why we really feel that way. So if you have any questions as I'm going through the presentation, feel free to type those questions in and submit them to us. If I don't end up answering the question here in the presentation, then someone will definitely get back to you and respond with an answer to your question if it doesn't get answered here as I move through the different slides and the information. Again, I'm going to try and keep this down to maybe about 30 to 40 minutes total. And then we've got a very special offer that we're going to make at the end of the presentation. So you want to make sure that you stick around for that. So what are we talking about when we discuss the three different investment worlds? What I'm basically saying is that if you look at the landscape, there's a lot of different financial advisors that are out there. And some of us have different acronyms and titles behind our names and things like that. You don't really know who to believe and who to trust. And what ends up happening more often than not is you'll hear conflicting information from different types of advisors. And the reason why that is occurring is because most advisors, not all, we're going to talk about some of the differences, but most advisors really only represent one of the three different investment worlds that are out there. So you have basically banks that are competing for your investment dollars. You have insurance companies that have different products, as well as what we refer to as Wall Street, or maybe just stock brokerage firms as well. So if you meet with an advisor that maybe only represents one of those three entities, well, they're going to be pretty biased on the information, the recommendations that they give you, and they will only talk highly of typically the products that they represent themselves. The good news is, again, we'll talk about this a little later in the presentation, there are some of us in this industry that can operate in all three of the investment worlds, but not all three are ever appropriate for everyone. There's times to use them and times to avoid them. And as we move through the presentation here, you're going to see, where each of them really makes sense, and again, where some of them maybe should be avoided from time to time. So what we have here is we're going to start out talking a little bit about Wall Street and what they have to offer us typically. Let me get myself moved here on the screen there. Okay. So Wall Street, if you're working with an advisor that works for one of the traditional brokerage firms, usually this is where you're going to fall into the category of being recommended things such as stocks, bonds, mutual funds, ETFs, SMAs, or separately managed accounts. And then occasionally, especially if you're maybe a little bit of a higher net worth investor, they may get into some alternatives, such as real estate, not necessarily just for high net worth investors, but maybe precious metals, multi-limited partnerships, doing some options trading, things of that nature. There's a time and a place, or there can be a time and a place for each of the different options, but let's hit on some of the more common options quickly that they like to recommend from time to time. So, of course, stocks are an area that most stockbrokers or advisors that are working or representing some sort of a stock brokerage firm or Wall Street firm, they're going to recommend one of two different types of stocks. Typically, the most commonly used stock is just that. It's a common stock. So this is when you're at home at night, you're watching the news, and you're seeing, the Dow was up or the S&P 500 was down, the NASDAQ, things of that nature. Usually what they're talking about there are just going to be commonly traded stocks. So this is like your GMs, your Fords, your IBMs, Facebooks of the world, where you own shares in the company. You represent a very small percentage in ownership typically. There could be different types of stocks you may invest in. Growth stocks, which are stocks that really have the ability to grow. So maybe a Facebook years ago was a growth stock. Now they're pretty big. If they were undervalued, then maybe they would end up becoming a value stock. So you have both value stocks or growth stocks, of course, small, mid cap, large cap, and some will pay some dividends. Although, of course, what we're seeing right now is that a lot of companies are cutting completely their dividends or reducing them. I think I saw a statistic recently that about 65% of the publicly traded companies have either already cut their dividends or they have indicated that they're going to have to do that in the weeks and months to come. So sometimes they pay dividends, but those dividends are not guaranteed. And then you also have preferred stocks. Now, preferred stocks act a lot like maybe a bond or a corporate bond. They're similar to that, really, than compared to just common stocks. There, you usually do have kind of a class of ownership that's in a little bit of a preferred position, and in case there was some sort of liquidation or bankruptcy or something that were to occur in the company, preferred stock holders would get their money back before common shareholders would. And the whole reason why you typically would buy a preferred, though, is because there is almost always a dividend that's declared that's pretty consistent. Again, now in times like this, may not be guaranteed, but the reason why you buy preferred is not usually because you think there's a lot of upside appreciation within the value of the stock. There's usually some, but that's usually not why you buy it. You usually buy it because they're paying typically pretty healthy dividends, maybe somewhere in the 5, 6, 7, maybe even as high as 8% range. Usually preferred stocks are going to be maybe energy companies or financials. But in this environment that we have right now, a lot of that is kind of up in the air. So preferreds are usually a little more stable than common stocks, but you got to be very, very careful with the energy and the financial sectors right now. So those are the different types of stocks you can have. You can also have some bonds within the portfolio, and usually individuals will use bonds because they are trying to reduce the overall risk. So the bond is a debt instrument where you're going to get some sort of detailed interest rate as long as you hold the bond and the company performs or the government performs and there's no type of default. So here the interest rate is a little more guaranteed, not exactly what you could call 100% guaranteed, but a little safer maybe than individual stocks. There are interest rate risks that you have to be aware of with bonds, meaning as interest rates go higher, bond yields will go lower, and that's going to drive the value of a bond down in most cases. This is particularly important, which we're going to talk about here in a moment, if you have any money invested in bond and mutual funds, where there's a lot of risk there associated with those types of assets right now because of where interest rates are currently. So in the bond markets, you could have corporate bonds, you could have government bonds, and government bonds can be local government or the federal government. But most advisors that you talk to, if they're limited to just offering things that a traditional stock brokerage firm would recommend, they're going to usually recommend that you have some sort of mixture between stocks and bonds. Let me move my picture here for you again. Okay, another big area of recommendation for advisors that work at these types of firms are, of course, going to be mutual funds. And of all the different investments that are out there, of course, more people have money invested in mutual funds than anything else. So Some good things and some bad things with mutual funds. The good things are you can get a lot of diversification, usually in a pretty easy way. So mutual funds are a collection of maybe stocks or bonds, typically, although there are some that will venture into real estate and other types of commodities, things like that. But usually stocks and bonds. The fund manager, he or she, is in there buying and selling those different stocks and bonds throughout the weeks or months or the years that you hold the fund, trying hopefully to generate a good return for you. It's, like I said, probably the easiest way to achieve diversification. So that's good, especially when you're just getting started. When you don't have a whole lot of money within investment accounts, mutual funds can make perfect sense. In my opinion, as you get up over maybe $250,000 or certainly over $500,000 in investable assets, now mutual funds probably aren't necessarily the best place to have your money invested, at least not the majority of your portfolio should probably not be invested in mutual funds. And there's a few reasons why we feel that way. One of the first problems with mutual funds is they are all traded at 4 p.m. So I'm going to try not to get too technical here. But basically what that means is that mutual funds, whether you buy into them or you're trying to sell out and liquidate your assets, all of those trades take place at 4 p.m. So no matter what happens during the day, if you make the decision to buy or sell that mutual fund, you don't get the price at that time. You always get the price at the closing. Well, in volatile time periods like we have right now, that can be fairly risky because you usually want to buy into a mutual fund if you can time it right. You usually want to try and buy into it on a day when the market has gone down, so you can buy more shares at a lower price. And then if, again, you can time it right, you typically want to sell a mutual fund on an up day, so to kind of maximize what you're going to get as you liquidate it. But because they're bought and sold at 4 p.m., especially in times like we're going through right now, you have little to no idea if that fund is going to be either up or down for the day. You know, that last hour or certainly last 2 hours of trading each day, there's pretty significant movements in the stock market. So you just don't have a whole lot of control is what my point is here. And there's not a lot that the advisor can do to try and maximize or minimize, you know, the return that you're getting as you're moving in and out of it. In addition to the trading issues that I'm talking about, there are a tremendous amount of fees and expenses. And there's two different categories on these fees. There's what's referred to as stated cost and then unstated cost. So some of the stated costs are going to be things like management fees. This is where you have marketing fees, which are referred to as 12B1 fees, maybe a front end or a back end load or commission that you have to pay when you buy into the fund or sell out of it in a particular amount of time. So those things are usually readily available if you know to ask what they are. Or again, you can maybe take a look at a prospectus and search through it and find, you know, what those costs are going to amount to be by doing a little bit of research. But when you add all of those stated costs up, it's not uncommon for those to maybe tally about 1 to 1.5% per year. But that's not the whole story. In addition to the stated costs, you also have the unstated costs. Now, if you were to do research within a prospectus on a mutual fund, you might see that these costs are referred to or they're referenced that you're paying or going to have to pay these costs, but they don't typically ever tell you what they are. They don't have to tell you what these costs are going to be. In some cases, they don't really know what it is until after the fact. But some of the unstated costs, as you can see, are going to be the trading costs, commissions, market impacts, which is some of what I just kind of mentioned a little bit, and then taxes. I just want to touch on two of them briefly for you right now, and I'm going to move on from the screen. On the unstated costs, really two of the biggest impacts that we see are the trading costs and the taxes. What trading costs are this. So each mutual fund, stock or bond or whatever it's holding, the fund managers and they're buying and selling almost every day. And they're trying to maximize the returns. And sometimes they do a good job of that, and other times not so much. But anytime that they buy or sell a stock or a bond within the fund, there's a cost for that. That is not free, and you have to pay that cost. It's passed through to you. The typical trading cost is around 1% for most mutual funds. So again, I don't want to get real technical here. Your typical growth mutual fund is going to have about 100% in what's called trading or turnover that occurs during the course of the year. And if you're paying 1% in fees on 100% of the trading, that obviously equals another 1% in true costs that gets passed through to you on top of the stated costs. So when we take a look at trading costs on top of management fees and loads and things of that nature, it's not uncommon for us to see individuals paying 2.5 to sometimes 3.5% per year on their mutual funds. So to put that in perspective, if you have $100,000 in a mutual fund, let's say the fee is only 3%, that's $3,000 per year. The bigger issue is when you multiply it over multiple years, over a 10-year time period, you could pay as much as maybe $30,000 in fees on just a $100,000 investment. Now, if you have $500,000 or $1 million or more in mutual funds, you begin to see the problem with them. And why we usually say as you get to higher levels of liquid net worth, you need to try to avoid them. The other major issue why you want to try and avoid mutual funds typically is you start to accumulate a fair amount of money in your investment accounts are going to be the amount of taxes that you're going to have to pay, in particular on non-qualified accounts or after-tax accounts. So IRAs, 401ks is kind of a moot point. The money's going to grow tax deferred. You take it out, you got to pay tax at whatever rate you're at in that given year. But on a mutual fund that's in a regular taxable account, in my book on retirement planning, I said that mutual funds are probably one of the worst investments that you can have in a regular taxable account. And the reason why that is because you're subject to triple taxation on the growth of a mutual fund. And here's what I mean by that. So basically, if you have a mutual fund and let's say you buy it for $10 a share and you hold it for a few years and you sell it in the future for $15 a share, well, you're going to have to pay a long-term capital gains tax on that growth. Okay, the difference, and for most people watching right now, that's going to be about a 15% tax. That's the first tax. The second type of tax that you have to pay is you have to pay taxes on the short-term capital gains that happen along the way. So you have long-term capital gains over time, but each year you have short-term capital gains that are generated each year. A typical growth mutual fund, again, is going to have about 100% turnover or trading that occurs during the year, meaning they sell off 100% of the assets and buy all new stocks or bonds within the fund. If that happens and the market happens to go up in value that year and the mutual fund makes money, then that means that all of your gains, let's say you get a 10% gain, all of those gains are subject to short-term capital gains taxes, which is going to be ordinary income taxes. So not the low 15% rate like you have on long-term capital gains, but short-term capital gains are taxed at a much higher federal bracket, usually in the 20, 30, some cases as high as almost 40% range. So that's the second tax. And then the third tax that you have on a mutual fund is the dividend tax. And what this is most mutual funds will declare a dividend. Almost everybody just reinvests the dividend back into the mutual fund to buy more shares. That's not necessarily a bad thing to do. But even though you didn't collect and receive the dividend yourself, the government still wants to get paid on the dividend that was declared. Again, this type of dividend is taxed at ordinary income taxes. So even though you didn't receive the money, you have to pay whatever federal, state, local tax bracket you're in. You have to pay those taxes on the dividend that was declared. This third type of tax that individuals have to pay on a mutual fund is the one type of tax that can actually cause individuals that have a mutual fund in years, maybe like this year, we'll see when we get to the end of it, where individuals may actually lose money for the year in their mutual fund, but they still get a tax bill on the gains that mutual fund had that year. And the reason why is because even though you lost money on the mutual fund, if that mutual fund declared a dividend that year, you have to pay tax on that dividend. So we saw it in years like 2001 with September 11th. We saw it again in 2008. That something that really upsets individuals when they lose money on an investment and still have to pay taxes on the gains. They look at that and they say, "What in the world is this? I didn't have any gains." But that's why we say try and avoid mutual funds, in particular in just regular taxable accounts. There are options that are much more efficient. So as I'm talking about this, one of the things that everybody can do, again, don't forget you can submit your questions to us as I'm going through the presentation. Again, if I don't answer them on one of the slides, then someone will definitely follow up with you. We'll get you a answer to your question. But you also have the ability, if you would like to, you can click on the link and you can schedule a portfolio review. And what we're doing here is we're scheduling just a real simple 15-minute phone conversation with one of our advisors. If you need to have a further conversation beyond that, that's fine. We can do that. But if you just have some real simple questions, you need some easy answers, we're here for you. We can help you with that. Just click on the link and we'd be happy to provide that for you. And then again, here at the end of the presentation, I've got a really special offer that we will be making to everyone as well. Okay. So another option or an alternative that we're bigger fans of than mutual funds, and it's something that we sometimes will use here at the firm, is something that's referred to as an ETF or an exchange traded fund. Here it's similar to a mutual fund, but they have some advantages. So where they're similar is there's still a collection of typically stocks or bonds, or again, you can have real estate or other types of commodities. They are a great lower cost option typically to mutual funds because you don't have the high fees and expenses that we were just discussing, either stated or unstated. So ETFs are becoming more and more popular as individuals learn more about them. You don't have a fund manager that you have to pay. They usually don't have any 12B1 or marketing fees that have to be paid. And the turnover, the trading, the commissions that goes on within the fund are usually very, very small. So again, on a typical growth mutual fund, maybe 100% of the portfolio is turned over each year. That creates additional trading costs and commissions that have to be paid. Also, other tax issues we just touched on. ETFs kind of avoid those or at least minimize them, where there's very little turnover, maybe 1% to 2% per year. So it keeps your short-term capital gains taxes very, very low. It's a passive investment, so you don't have a lot of active trading that goes on, and you can still gain the same type of diversification that you have with mutual funds. So we like ETFs as a nice alternative to mutual funds, and I really think that over time, as people learn more and more about ETFs, I think they will surpass mutual funds as far as popularity. But mutual funds have been around probably 30 to 35 years longer than ETFs have been. So it's going to take a little while for them to get there. But eventually, more individuals will prefer ETFs versus mutual funds as they find out that it is a better option for individuals out there. Okay, so that's kind of what Wall Street typically has to offer us. So again, if you talk to a stockbroker or an advisor that just works with one of the major brokerage firms that we've all heard of, almost always they're just going to recommend some mixture of the options that I just gave you, right? Stocks, bonds, mutual funds. Maybe they'll get into ETFs, things like that, and that's it. What they typically do there is kind of take an approach of just set it and forget it. You've got a diversified portfolio, good market, bad market. You're in it for the long run. You're just gonna ride it out, and that can be an okay approach if you have more than 10 years to go to retirement, and if the economy and the markets aren't very volatile, then that can work in those circumstances. But if you're within 10 years of retirement or already retired, and certainly with the volatility we're seeing today, that's not an investment approach. That's not a suitable investment approach that I would recommend anybody take right now. So one alternative would be to take a look at what banks have to offer you. So again, 3 different competing entities typically for your money. And right now, banks of the 3 that we're going to talk about, they're probably the least competitive right now. It kind of ebbs and flows a little bit over time. But if you talk with someone at your bank, if you can't really go inside right now, right? But once we get back to where you can go into the bank and maybe talk to the teller, if you're making a deposit or something like that, they'll say, hey, do you know you've got too much money in your checking account? We've got some options here. Maybe you could take a look at. And so usually what the bank has to offer is different type of cash options as vehicles to use. So maybe a money market or some sort of a savings account where right now returns are almost nothing, but maybe you get a little better than what you're getting in the checking account. Banks also a lot of times will push and recommend CDs, in particular for individuals that say that they are very conservative investors. So a CD is a pretty simple instrument to understand. And again, you can get a better return typically than just maybe a money market or a checking account. You do have to make some sort of a time commitment, usually anywhere between 1 and maybe 10 years before you plan on taking all of the money out. Most of the time, it's usually in a 3 to 5 year time frame. But again, CDs right now just aren't paying very much interest. And then occasionally they'll recommend savings bonds. That's of course where you usually see maybe grandparents buying different government issued savings bonds for their grandkids to pay for college and things of that nature. So I like some of the options that the banking world has to offer individuals. I just, of course, don't like any of them right now. At some point in the future, when interest rates go higher, I'm sure that they'll get a little more competitive, and then we'll start to take a look at them again. But just right now, of the 3 competing entities, they're not that competitive, but of course, they're still out there trying to get your assets under management with them. The third and last competing entity that we're going to talk about here today is going to be the insurance world. And usually you have 2 different main options within advisors that represent, say, insurance companies only. And that's usually in the life insurance realm as well as the annuity realm. And I'm going to talk real briefly on the life insurance, but we'll go into a little more detail on the annuities because I'm sure that's what a lot of people are hearing more information about. Kind of keep moving my picture around here on the screen. So let's touch briefly on the life insurance side. What I find amazing is a lot of times if you talk to a stockbroker, again, they think, stocks, bonds, mutual funds are the answer to everything. If you go into the bank and talk to the teller, they're going to say, no. You don't want to take any of the risk. You need to get something real safe, secure, like a CD or a savings bond or something like that. And then if you meet with an advisor that kind of represents an insurance company only, they're going to kind of think that permanent life insurance is the greatest thing since sliced bread. And permanent life insurance can definitely have a place in your portfolio. I just see it a lot of times kind of missold. I mean, they're not structured properly, and there's some good things about them, and it can really be a nice fit into your portfolio. However, you need to understand both the pros and the cons of going with some sort of permanent life insurance plan. So to give you just a little quick overview on it, to give you a little bit of education on it here today, usually permanent life insurance is, you have term and permanent. We'll talk about term in just a second. But permanent life insurance is just that. It should be an insurance policy you can have for the rest of your life. So it's kind of like buying a house as opposed to renting a house. Term insurance is a lot like renting a house. You pay on it. At the end, you have no equity built up. Permanent insurance is like buying the home. You're going to build up some equity. Eventually, you can stop paying on it and you own it. So you have universal life was popular back really in the 80s for the most part. Interest rates did not cooperate, so a lot of those have not performed well. You have indexed universal life, which is a popular option right now because they're not so interest rate sensitive. What's referred to sometimes as IUL plans can be an appropriate investment for certain situations. You don't have the interest rate concerns, and you still have the safety and protection that a lot of people are looking for when you invest in this type of instrument. So some of the benefits is you're going to build cash. You may have dividends that are declared each year and paid to you. You do have investment growth opportunities, and probably the biggest benefit of having money invested in permanent life insurance is whatever growth you are getting will be completely tax-free when structured properly, and you can withdraw those funds completely tax-free when structured properly. But again, working with somebody that has experience in these plans will make sense in order for you to get those tax-free benefits. You can add some combination plans where they'll have some coverage for long-term care needs as well as maybe some nursing home care if you think that's going to be a concern for you in the future. Moving on to term life insurance. Again, it's kind of like renting the home. You're just renting the coverage for a period of time, no cash value. Typical term life insurance policy is going to last maybe 10 or 20 years, something like that. Some plans go all the way out to maybe age 70 or age 75, but you're just paying purely for the insurance. Hopefully you never use it, and if you don't, then there's nothing that is returned to you on the back end. So a lot more we can talk about insurance or life insurance, but for today's purposes, I just want to go through it real fast so I can spend a few more moments before we get wrapped up here talking specifically about annuities. Now, when you get into the world of annuities, there are good ones and there are bad ones. So I never subscribe to this idea that you should never invest money in an annuity. And we also don't subscribe to the idea that 100% of your money should be invested in an annuity either. They have a time and a place, but there's certainly, even though there's a time and a place for them, there's some kinds that we would almost never recommend. And the first one that we can talk about is the one that most people are familiar with that we are not a big fan of, and that's variable annuities. So with a variable annuity, the money that's inside of it is going to be at risk, typically invested in mutual funds. So you have a different selection of funds to choose from. The problem with variable annuities and why I'm not a big fan of them is the fees and expenses can be absolutely outrageous on these types of plans. It's not unusual for us to see variable annuities have an annual fee structure somewhere in the 3 to 5% range is pretty common. We've seen them go as high as 6, 7, or 8% per year. Fortunately, that's rare, but we've seen it. So again, and let's just use a generic example of 4% per year. If you happen to have $1 million right now as a round number invested in variable annuities, that's $40,000 a year that you'll pay in fees and expenses. The market has to get 4% every year just for you to break even. And they never reduce or eliminate this fee. So over a 10-year time period, you could pay as much as $400,000 in fees on a $1 million investment. It's one of the biggest ripoffs that we see, in my opinion, in the financial services industry, but they're very, very popular with really kind of two different advisors, maybe advisors that represent only insurance companies, of course, but then also some stockbrokers and advisors at different brokerage firms are big fans of these because, quite frankly, in my opinion, because the commissions here are just incredibly large. Next to a hedge fund, a variable annuity is literally the most lucrative financial product that an advisor can recommend to you. So, of course, hedge funds are typically only recommended to people with very high net worths. But next to a hedge fund, variable annuities are the second most lucrative product that an advisor could recommend to you. So sometimes I'll get asked when individuals find out they've got a bad variable annuity, it's not performing well. Usually why it's not performing well is because the fees and expenses are so high. And they'll ask me, well, why do I have this if it's not any good? And of course, I wasn't the advisor that recommended it. I don't know. But I think the fact that they pay such high commissions might have a little bit of something to do with it. So we almost never, or pretty much never, recommend a variable annuity to anyone. It's just they're too expensive. There's better alternatives. One alternative might be a fixed annuity. Here we have safety and guarantees and no fees, which are good. So the money here is similar to a CD. Typically, you're going to get a little better return, not always, but typically a little better return than what a CD will pay. I think most fixed annuities right now are probably paying somewhere in the 2 to 4% range, 5% if you're lucky, and we can find that. But most of them are going to be 2 to 4% right now. The good news is no fees or expenses like we have with the variable annuity. So as far as fixed annuities, we like them. We just don't like them that much right now because I think interest rates are too low. If they were to get back to where they're paying 6 or 7 or 8% again in the future, like they have in the past, we may start to recommend them. One annuity that we do like that we're fans of in the right scenario is the index annuity. So with the index annuity, you're almost kind of combining, the good things between the fixed and the variable annuity, but you're eliminating some of the bad things. Here, you're going to have potential to grow with the market, but you have the safety of both your principal and your growth each year. So as the market grows, you can grow, but when the market falls, you don't have to give any of those gains back. And with a really good index annuity, you're not going to have any fees or expenses. Some of them have some fees, but most of the ones that we work with, there are no annual fees or expenses. Similar to a CD, you do have to make a time commitment, ranging anywhere between maybe 1 and 10 years before you plan on withdrawing all of the money out of the account. And you also have the ability, if you want to turn the account into guaranteed income for life, which is another attractive option to these types of plans. So you're going to have the safety of your principal, opportunity to grow when the market grows, and then in the future, if you want to or if you need to, you can turn it into a guaranteed income for life. That usually fits nicely into most people's portfolios, not everybody's, but it can be a nice foundational piece into some individuals' portfolios that are looking for that. And then you can add some different benefits as well. You have different riders that will typically come at a cost, not always, but again, option for lifetime income, maybe, some options for beneficiaries if you were to pass away, also some long-term care benefits, things of that nature. So as we start to wrap up here today, as I've gone through the 3 different investment worlds, a lot of times individuals will say, well, how do I know which option is best for me? And which one do I invest in? And there's a couple things you need to do to figure that out. First, we always recommend get some sort of a risk assessment done. And this is, again, something that we can do at our firm, whether you're a client of ours right now or not. We can take you through a little exercise and see, what level of risk is most appropriate for you and how comfortable are you with it. Now, it's really interesting when we do this with couples, married individuals, significant others that are, domestic couples, things of that nature. Almost always one or the other is going to be a little more risky or a little more aggressive. However, after everything that's gone on in the market here recently, more and more we're seeing both couples are a little more conservative than what they were certainly 6 months or a year ago. But it starts out first with a risk assessment. All the different options that I just went through with you, maybe other than, if you have a large amount of money invested in mutual funds or variable annuities, almost every option that I just went through can have a time and a place. It's just a matter of what is most appropriate for you. And a lot of it comes back to starting out getting some sort of a risk assessment done so you know which options you should use and which ones you should avoid. So a couple other things that we take a look at when we talk with individuals is how long do you have before you're going to retire, or if you're already retired, how much money do you need on a monthly basis or an annual basis? Can you afford to go through a massive stock market correction? Kind of like we're seeing right now. However, it could get a lot worse. I hope it doesn't. But what if things continue to get worse? How long can you wait to get back to even before you're going to need the money. Know your level of risk and comfort level. Some individuals don't mind having some risk. The other individuals will tell us, well, I don't want any risk at all with any of my money. Well, obviously the investments are going to be different for those two different individuals. And then try and follow things like the rule of 100. We talk about that almost every week here on the webinar. Real briefly, rule of 100 means whatever your age is currently, that's the percentage of your portfolio that you should have safe and protected from risk. The difference between your age and the number 100 is the amount of risk that may be appropriate for you only if you're comfortable with risk. So someone that's maybe 60 years old should have about 60% of their money in lower risk, more conservative type of investments, no more than 40% invested in maybe stocks, bonds, mutual funds, ETFs, things like that. So good generic rule to try and follow. You can deviate from that sometimes a little bit, but you don't want to deviate too far. So as I mentioned earlier in the presentation, you have some advisors that are restricted to just one of these three different worlds. So you have, the stock brokerage firms, you have the banks, and you have people that represent insurance companies. What we recommend that you look for is work with someone similar to how, basically we're structured as strategic wealth designers. Look for somebody that's independent. We're not captive or tied to any one company, and we're not restricted to any one of these three investment worlds. We can operate in any of the three when it's appropriate. So again, within our portfolios, we may utilize stocks and bonds and ETFs from time to time, depending on the risk tolerance of the client. Again, we don't do very much with mutual funds because of how inefficient they are, but we have a mutual fund alternative in the ETFs. And we can even get into some alternatives like maybe real estate or commodities, things of that nature, for a portion of the portfolio. We're not bound by any types of sales quotas or required to recommend anything to our clients that isn't absolutely in their best interest, which goes to our second note that I have here on the screen. Work with somebody that is a fiduciary. Again, about 3/4 of our industry, the advisors are held to what's called a suitability standard, meaning they just have to recommend things to you that are going to be suitable. It doesn't have to be what's best for you. If there's a better option available, they don't have to tell you about it, just as long as the option that they're recommending is suitable, which you could argue that almost anything is suitable at one time or another. Avoid those types of advisors. Work with a fiduciary. We're about 25% of the industry, so we're not the only ones that are fiduciaries, but a fiduciary has to recommend things that are absolutely in your best interest. It can't just be better than what you have. It can't be, kind of good. It has to be what's best for you. And if we fail at that suitability standard, the penalties are pretty severe. When we go through audits with our regulators, we can lose our licenses, certainly be fined, sanctioned, suspended, things of that nature. So work with a fiduciary, work with somebody that has to act in your best interest at all times. Work with a firm that's team-based. So we have different specialists and different areas, some of which we've discussed here today. So we're not a jack of all trades, but we have individuals that sometimes when an insurance product is most appropriate, we have specialists for that. If we need to go with individual stocks, well, we have specialists with that. So we work together as a team. I think whoever you work with should be able to keep things as simple as humanly possible so you can understand it. And then know how advisors get paid. And they should disclose this to you up front, especially if you ask. So some advisors will work on fee only, meaning you just pay them some sort of a fee to do plans. They may charge you to put together a financial plan or something like that, or they bill you by the hour, things of that nature. Some are fee-based, where they may charge you a percentage of the assets that they're going to be managing. And then some may just be commission-based, where they get paid a commission from the companies that they recommend to you. Whether they're a suitability advisor or a fiduciary advisor, sometimes they will operate in a commission basis only. Again, as an independent firm like us, we can work in all three. It's just a matter of what makes the most sense for our clients. And then again, we can disclose it to them so they know exactly what the fees and expenses are that they're paying. So as always, you want to work with a fiduciary, someone that's independent, somebody that specializes in working with retirees and pre-retirees, if indeed you are at that age. At our firm, we have the ability to handle meetings right now, of course, over the phone, through conference calls. We're doing Zoom and FaceTime meetings as well for individuals that are more comfortable with that. And we have the ability to do some limited face-to-face meetings if individuals would prefer to do that. And I would really encourage everybody here today to take us up on the special offer that I talked about early in the presentation. And that is, we've gone over the three different investment worlds. We've talked about when they can be appropriate and when you want to avoid them. And I also mentioned briefly a little bit about doing a risk assessment. what it all really comes down to, in order for an advisor to know what's best for you and what you should recommend, or what they should recommend you to invest in right now, you need to have a retirement income analysis done, where you take a look at how much money you're going to be getting from Social Security. What are your goals, your objectives, your expenses in retirement? How much money are you trying to plan or leave to heirs and beneficiaries after you're gone? What type of retirement do you want to have? Do you want to travel? Do you not want to travel? We can take a look at all of that information, plug it into an analysis, and we basically can run things out to age 100 until both people are age 100 if you're married or with a significant other. And we can show you how likely, how successful will you be with your retirement plans. This is something that I think everybody deserves to know and needs to know. So what we're doing right now is, if you do click on our offer and schedule a visit with one of our advisors, we're going to run this analysis for you, if you'd like us to, complimentary. We can do everything, again, over the phone and through email, things of that nature. And because you've watched this webinar here today, that's something that we will do complimentary. It takes us a little bit of time to put it together, but we can get that put together for you. And then you'll know exactly what you should be investing in and how you should handle your investments as you move forward. And then last that I'll kind of have here on the screen for you here today is, if you've missed any of our previous webinars that we've done, we've talked about various topics that should be helpful. Be sure to go back and take a look at our website. We've got them all logged on there. You can share them with friends and family, so anybody that might need or want to know the information. Last week, we talked about what to do with your 401k if you've been laid off or are concerned that you may be laid off. And then, as always, be sure to follow us on our Facebook page, because we are making announcements there as far as what the upcoming webinar is going to be for that particular week. We've got some special offers and even some fun things that we're planning to do as we move through this unique environment that everybody is dealing with here today. So if you have questions that did not get answered during the webinar here today, please submit those questions. We will have somebody get back to you with an answer, and look forward to seeing and talking with everybody at some point in the future. Okay, thank you for tuning in.